Now we turn to the international market, and where do we see our exports going, and then what does just the demand look like on that global footprint? So just turning to the U.S., so here we had a fairly surprising increase in exports from gasoline. They were up 184,000 barrels a day. But it's also a timing issue, because when was it purchased? Is this some delays that were just being made up based on when they were sold prior to the Texas blackout? So these are things where we're starting to see some of that normalization in general. The distillate fuel moved in the direction we were expecting. Decline of 345,000 barrels a day. We're still, we'll see a little bit of a bounce in general. We thought there was going to be some stabilization in the distillate market. Instead, that might come next week, this week into next week. Again, just in terms of timing, because there could have been a makeup on gasoline. Now they'll make it up on diesel, and you'll go back and forth in general. Propane continued that bounce. It was up 371,000 barrels a day. That's something that's going to remain at this elevated level. It's still above the 5-year average by 158,000, down year over year by 121. That'll start to close that gap. It's just going to be those timing delays. The bigger issue is going to be those U.S. exports, because as we've been talking about, exports have really slowed. And just this is looking at future sales that we've seen and those headwinds that have come into the market. And it fell right where we were saying that, where the range that we were giving between that 2.6, 2.7, and we think there's a little bit more upside. We'll probably get closer to 2.7, 2.8 as we start to see a little bit more of a makeup for some of those levels. But again, this is still showing that we're still at these issues of what does oil demand look like in the global market, which is putting a headwind on U.S. flow. We did have that increase of 282,000 barrels a day, but China has really pared back U.S. purchases, and that was our largest buyer for at least over the last several months. But if you go back, it's been for over a year now. China's been the largest buyer, but now Iraq just came out. They're cutting their OSP into Europe. A lot of OSPs have been cut into Europe. You're starting to see some pressure on some pricing at the European level. Some of the refiners aren't coming back. We're seeing more slowdowns in demand in Europe in general. So that's another place that the U.S. crude normally ends up. So not only are we losing some Asian demand just based on turnarounds, timing, but we're also losing some European demand, which is again going to cap our exports, which will keep U.S. Crude storage elevated versus where I think the market is really expecting at this point in time. Then when we look at gasoline exports, we were expecting it to be below that 9-year average. Instead, we're just above. But this is something where we think now it's just going to trend back down towards that low point that we see at the beginning of March on that seasonal level. Then when we turn and we look at distillate, here you can see just how big that drop off was. This is something that it'll bounce back, but it's not going to bounce back to the bottom of the cloud. It's just based on where this is, and just based on where demand is in general. Because again, look at pricing. Like, if I can sell this internally or if I can sell this abroad, what am I going to look to do? Where am I going to get the best bang for my buck? And right now, it still remains in the U.S. So a lot of this product will stay out of the export market. Europe has more than enough right now to send into the market, and we've already seen that with some of the directions being changed from the U.S. into the Caribbean, and a lot of this will start ending up in Latin America. We do have more product coming from India, hitting into the West Africa, as well as, and more importantly, the Middle East, which is going to cap some of those European flows and keep them trapped within the Latin American and Caribbean markets, especially as the U.S. obviously continues to import. Then when we look at oil exports here, obviously we're still above the 5-year average, but we also have way more capacity at this point. It's just we think that we're going to remain fairly depressed, just given, again, those backdrops of where is that demand on a global level. Here we had a nice little bounce off of that level, and on the LPG side, again, this is going to stay elevated. It's just going to stay at the top of the cloud. We'll probably get some peaks above, but we think that we're going to average a little bit below where we were in 2019, just based on pricing, just based on kind of coming out of the seasonal differences. We've had some pare back in liquid pricing when we look at some of the Asian markets. So that will not depress, but that will keep some of these flows fairly capped in the near term in general, just looking at kind of where things are. And then obviously something comes out saying that copper rebounds on a Chile strike threat. That's always going to be fun just based on the inflation side of the equation. Now, as we said last week, we expected to see a bounce in crude storage in Europe, just because we did have a surprising increase in floating storage, and we figured it was just timing delay of getting it from the boat into storage. And here is that reversal that we were expecting, and maintaining, pretty closely to where we think the 5-year average is, where we're going to continue to see crude getting left in storage as we go through into April. Now, on the positive side, we did see a nice drawdown of stock at Fujairah. So stockpiles were down. So just from peak to trough, which the peak being June 2020, it's down 41% from that level, which again is that net positive that we've talked about. But the reason why that's happening is a bit more obvious as the arbitrage is open, just because the U.S. frees off, and just where the draws have come out of our products is just incentivizing and opening up some movement, which is why we're going to see an increase in imports coming into Pad 5. But now let's take a step back. And so the total amount stands at about 8 million barrels on March 8th, down 14% week on week, which is the lowest since September 9th of 2019, which again is a net positive in general. So what is really doing this? So the arbitrage route is open, and cargoes are being taken from Asia to the Middle East. So because of this, because Asia is so glutted, and now we're starting to see these drawdowns in the Middle East, you're starting to see those flows really start to come back into the market in general, which is a net positive in general. Overall, but again, it's also going to mitigate some of these movements. So we will start to see light distillate adjust a bit. So light distillates fell 523,000 barrels, which was down 7.3% week on week to stand at 6.2 million, which is the lowest since November of last year, where they stood at 6.3. So you're starting to get close to that November level, but the East of Suez gasoline market was finding support, with U.S. runs continuing to hold well below levels, but that's going to start to abate, because now you're going to start to see that get backfilled with product from the Asian markets. Then middle distillate fell 413,000 barrels, dropping to 3.7 million, which is down 10%, which is the lowest level since August 17th, which was 3.4. So we're getting close to those levels, but the gas oil market was under pressure, with a contango structure developing as supply concerns continued to plague that sentiment view. So you're starting to see those movements where contango's pricing in. That's going to start to incentivize a bit more builds in general. But when you look at the OPEC deal, OPEC cut production, but they've maintained exports so if you're maintaining exports, it means that you're drawing down, because you're going to reduce some of your refinery runs, keep oil on the water, and start pulling some of this product out of your storage. So this is where we have to look at what is happening in general. And the reason why is, like, when you look at trade participants, say the weakening value of gas oil is reflective of supply concerns. Chinese gas oil exports in particular continue to shift higher. So China demand is becoming a bigger concern in general, as they're pushing more refined product into the market, which is starting to cap. So even though these numbers are bullish on the aggregate, you're starting to see some of this backflow coming in from Asia, specifically India and China, flowing into these markets, which is again capping some of that movement, which is going to push European products into Latin America, the Caribbean, as the U.S. continues to absorb, just given where these shortfalls remain. So then when we look at stock of heavy residuals, they fell 1.9 million barrels, dropping 20% to 7.6, which is the lowest level since November 23rd, where it was at 7.2. So you're coming into these closer numbers. But we're starting to see an uptick in that bunker market, which was seeing some movements lower as some of these prices started to get into that level. But when we look at some of the issues in general continuing to reverberate through the shipping market, that's going to keep some of that cap. But right now, based on what we're seeing in the market, we expect to see builds come back into the light distillate, middle distillate side, but heavies and resid should continue to be fairly bullish in general. So we're going to get kind of this bifurcation between, bullish and bearish, but I shouldn't say bearish, just kind of neutral as we go through the next few weeks. But then when we turn to the physical market and where those loadings are, so here you can see Libya as, we're essentially going to be February into March. It's going to be fairly flat week over week, month over month. Russia started to see those increases. That's going to continue to grind higher. As they've talked about, they're going to be above May 2020. They expect to add about 900,000 barrels, which if you think May was 2020 was really near the low. So that's year over year. That's not a huge jump, but again, just showing that trajectory that we continue to see. Libya is targeting 1.45 million barrels by the end of the year. Based on some of the commentary out of the unity government, where things are sitting, that's very doable. It's going to take investment. I'm not saying it's going to be easy, and obviously you have another 9 months to do it. So it's not like it's going to be a long road, as they're already at about 1.25. So you're thinking about closing and increasing another 200,000 barrels or so, which is doable with repairing pipes and getting some of these these fields back at I don't want to say tip-top shape, but at least better from where they were over the last 2 years. So when we look at Angola and Nigeria, we continue to see issues in the March and now even into the April market, as we're starting to see cuts coming through across the OSP side, or the official selling price. So the official selling prices have gotten weaker, these are the first guys to really start to sell, as we're days away from May actually getting released for Angola, and they still aren't even there. So let's put that into context. So Shandong cut its offer price for the April loading cargo of their Mostardo crude to a deeper discount to dated Brent. It was offered at 50 cents less dated Brent, and it was initially 10 cents above on February 26th. Then it was 10 cents below on March 3rd. Then it was 30 cents below on Tuesday. Now it's 50 cents below, just to give you an idea that they just can't get someone to come in and take this cargo. Now, on the flip side, we did get a little bit better pricing into the Ural side. And just to give you an idea of what does that mean, we were trading anywhere between down 230 to 275. We're now down $1.85. So it's off the lows, but we're still hugging that bottom, which is coming into becoming a bigger issue as Europe remains low, as problems remain in Asia, which is becoming that bigger concern. But just to put it just in terms of where we sit. For Angola, currently only 1 week to go until their May program, as it comes out next week. There's 15 April cargoes still available, and that's very, very slow. That's something that we haven't seen in years, and again, that speaks to China demand, because that Angolan cargoes are their base, and really where 60 to 70% ends up getting filled is China. So if they're not buying, they're going to have to start to compete. That works well for India, who's looking to diversify, pick up more cargoes, move away from the Middle East, just in retort to Saudi Arabia. So we're going to start to see some of those shifts. But then on the flip side, speaking to how Europe is weakening to a certain point, we continue to see issues coming in to the underlying market with actually I lost that. Hold on. Let me move this up. So the diffs are weakening, and right now we're at the low pricing. And now it's still positive, but it's still been shaved. We keep losing about 10 to 15 cents each week. And normally, so now we have Fortes at a 34 cent premium, OSC at 65 cent premium, EKO 56, Troll 70 cents. And many of these were at about 90 cents to $1.10, to give you an idea of kind of how much this has fallen, just given where some of those issues are. And with that being said, the crude oil side on the water still remains along the 5-year average, but it's being shifted as to what is driving this particular on the water number, where oil in transit has fallen because, again, there's been a slowdown in purchases abroad, which has limited the amount of crude in transit. But it's also put more crude in floating storage, which we've seen this now back above and heading towards the high that we had in the beginning of January. And, speaking to the issues that we were referring to before, ships are waiting longer to offload in Shandong, China's Shandong province, with now they're at about 12 days to discharge versus the week ago 8. So you're starting to see those issues come through. but that's also because they're also unloading more. So crude imports in the region have jumped to about 8.7 million barrels a day over the past week. And, when we look at the week prior, they were only at 3.9. And the average import volume so far this year is 3.8 million barrels a day. So, but it would make sense to accelerate because you have more boats showing up because you purchased a ton back in November and the first week of December. Now things are starting to flow through, and you're going to start to see this pull on into that market while we continue to see those builds onshore, which will limit the amount of new purchases that we're going to see in the market going forward. And this is giving you an idea of where's India going to buy from, because here, when we look at Venezuela, obviously that dropped off due to sanctions. But when we consider where things are on Saudi Arabia, this yellow, we expect to see that yellow continue to drop down. And now we should see Nigeria start to pick that up a bit. And we expect to see a bit more Angolan cargoes, start to price into this market, just given where some of those shortfalls are. And just in general, you can see how, January was a little depressed from December, but we're still getting closer to that year over year, still down 2 to 4%, depending on where you're looking at. But again, starting to get towards that pretty stable level. And then OPEC share of imports coming into India continued to drop. Non-OPEC is picking up that pace. We have more coming from the U.S. We have more coming from Brazil and some of these other regions. But again, just also shows just what some of that pressure is coming in, and just the way this is classified. Russia is obviously becoming a bigger part of that as well. Some of those things are becoming net positives, but you can see that there's the market share issue. So this is where we have to consider how much is Saudi Arabia going to hold serious? Are we going to start to see OSPs get cut into Asia to try to protect some of this market share? These are going to be things that we're going to have to keep the finger on the pulse. Now, when we look at what happened last week in Europe, here you can see just where we have continuous builds, specifically in gasoline. This is actually with gasoline exports increasing, gas oil exports increasing, but yet we still have these pretty stable builds on a net aggregate, while gas oil hangs around really kind of that 15, 17-year average, which they're just trying to work with just storage, maintain storage levels, not let them get too crazy, as demand remains a bigger problem within the European markets. But there is a lot of demand in the US and LATAM at this point, and just because of some of those issues that we've seen roll out into the market, which they're going to be happy to try to backfill. So then when we turn to gasoline, you can see gasoline is now peaking back above to that new seasonally adjusted all-time high. We're now at the high for 2021 of gasoline and storage in Europe. And this is with a big acceleration of exports, to give you an idea of how weak some of the demand is, and is actually continuing to slow down on that high frequency data that we've been talking about, and we'll talk about more in the Econ show. Now, when we turn to Singapore, we're continuing to see builds, and this is obviously last week, but the builds are going to continue just based on Indian exports and Chinese exports. The question is going to be how much of that makes its way into the Middle East versus staying in Singapore, and it's going to be fairly split. But if you're getting a rise in exports, that means you're going to get a decline in imports, because if you could, you'd sell it locally, and if you can't, you're going to put it into the export market, which is going to keep these numbers elevated. And you can see that we're trending back up. We're back to the high of 2021, trending in the wrong direction for the aggregate amount. And then when we break that down into middle distillate, we're still at seasonally adjusted all-time highs, still off the 2021 high, but still looking at this, when we go back 15 years, we're still very much at the elevated level. And just based on those shifts that we're seeing in the market, that's not going to change anytime soon. If anything, we think it's going to kind of go sideways, maybe fall a little bit more into the bottom of into the top of that cloud. But again, not anything to really work through some of these elevated levels in the market. Then when we turn to gasoline is now back at the high for 2021, pushing towards the elevated level. And there's just based on demand in India, pricing in general, there's really nothing to see in terms of where things are. Like, something just came across saying that Argentine gasoline diesel sales tapered off in January as the virus increased. Gasoline sales were down 5.3% month over month, 9.4% year over year. Diesel demand fell to a 3-month low. Again, these are just pointing to the issues that we continue to see on the international market that is just going to kind of cap some of these levels, where China was the growth story at the end of last year. As we said, it was going to slow down. It did. Now everyone's turning to the U.S., but again, that we have to go through the noise, and the issue remains that weekday problem as people aren't really consuming the same amount. With that being said, we have that time spread coming to the low, but again, still at the very elevated level. But that's also putting pressure on refining capacity. When we look here at Singapore, you can see that we're trending. Most of this is now negative as we see pricing going up, as we see these headwinds continuing to persist. It's just trending in the wrong direction, which speaks to softening demand, as well as just that margin, which is going to keep them kind of capped as to what is their demand going to be on that crude level. And just putting it into perspective, we're at a seasonally adjusted low, really not any different than the lows that we've seen for most of 2021. But you can see just how far off of the average we are on the Singapore cracks. Now shifting to Urals, you can see that we've had a pretty big drop in Urals, and that's reflective of pricing getting a little bit better. But prices got a little bit better just as demand was weakening. So again, it's going to hang within this level, and we think it's going to tighten up with some of the heavier ends. Some of the lighter ends going negative again, just given the elevated level of gasoline in the market. Then when we turn to just the Mediterranean, as we've seen now, Iraq, we've had Iraq, Saudi Arabia, Libya, all cut pricing into Europe, and now you're kind of seeing why. So they're trying to cut pricing to maintain some market share. Again, Libya is continuing to take market share as they cut their OSP by $2. Again, trying to get more aggressive in this market, which is also going to price out U.S. product and kind of move that along. And you can see just what the pressure looks like, and there's no real necessity for European refiners to run any elevated or just maintaining these current levels, just given where prices are, where local demand is, and this is factoring in obviously those export levels. So then when we look at crude, China super tankers, we're coming back towards the top of the cloud as things show up. That again, this is coming to what is in transit versus what is in storage. And then when we look at just the activity in general, you can see that the Shandong independent refiners still remain elevated, producing at 74%. They should be at 67% by now, just based on kind of those historics, 67% to 65%. But they're probably, and my assumption would be, is they're trying to get ahead of some of this extended downtime. So they're looking to build and put more more product in storage before they start to pare back, as the state-owned entities still remain fairly low versus some of the historics. That's not saying the same in South China. South China is very much elevated versus historics, but pretty much everywhere else in general is still well below seasonal averages. So that should start to switch as we see Shandong coming down and some of the state-owned starting to ramp up. But then just that's, again, speaking to why we think Asian floating storage is going to continue to go higher, as we've been talking about. And then here's where that North Sea side still remains elevated. And the problem is the prices are coming down to try to get new people to purchase. China has slowed down their buying. So this is going to remain elevated on the storage level as they still remain near a 10-year high on those loading schedules that we've seen over the last couple of months. West Africa is one that we think is obviously going to pivot higher. We thought it was going to happen this week. It's just going to be a matter of when are they loaded, because at this point, we still see a lot of those significant issues on that pull-through of product, which is going to keep West Africa fairly elevated. Middle East, really nothing to write home about, just in terms of where things are going. Obviously, the production levels have tampered down, so they can pull from storage, they can pull from other regions. So there's really no rush to kind of get stuff into market. So here, there's really not much to say one way or the other, especially that there really hasn't been much issue following the Iranian attacks. Europe is starting to move from floating to onshore. That's going to continue moving this further towards that 5-year average. But in general, this is just looking at what's happening in China. So we've pared back off of the 2021 highs, but we still remain at seasonally adjusted highs over the last 5 years. And just given that timing delay and just what we continue to see, these will remain elevated going into the end of the month. And this is just talking about that fuel oil that we've been talking about, gas oil, distillate in general. This is trending up. Exports are increasing. So this is something that's going to be the one to watch to get an idea of what does Chinese demand look like, because we still see a lot of headwinds in the Asian market, specifically on the Chinese side. So I know we covered a lot. Hopefully this was helpful. If you have any questions, please let us know in the comments. We always appreciate the back and forth. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.